One of my fantastic subscribers had told me about a trading approach which had seen an investor turn the $10,000 he held in 1970 into almost $1 billion via 6 different investments over the course of 50 years. This video explores these investments and identifies some key takeaways that can help to inform our future investing approach. So let's dive on in. Now, this channel provides global macro insights and preaches the virtues of sound money and sound economics, so do consider subscribing. So Egon Von Greyerz explains this in a fascinating article where he sets out clear criterion as to only make one investment decision every decade from 1970 by focusing on an unloved asset class which was well undervalued. It provides an asymmetric bet and limits the potential downside of price falls because it's so cheap. While having an understanding of the business cycle and macroeconomic fundamentals provides a clear insight into whether demand for these assets is likely to rise in the future. The approach really shows the benefits of long-term investing, enabling a compound approach over sustained periods of time. I will simply be focusing on nominal sums and won't be considering capital gains taxes, which vary considerably around the world. So going back to 1970, the first move is to change the $10,000 for gold, which is fixed at $35 an ounce. After a fairly rocky ride, you're able to sell the gold at the start of 1980 for $559 an ounce. This turns $10,000 into $159,700. Sticking true to the mantra of a new investment strategy for each decade means that Egon now focuses upon where he will invest the 1980s. Now, Japan's rapid industrialization combined with favorable demographics offered a considerable demographic dividend towards investors. Now, when we combine this with Japan's loose monetary policy approach, which is promoted by the Bank of Japan, which we controversially discussed in this video, meant that Japan grew strongly throughout the 1980s. Investing $159,700 into Japan in 1980 would have given a 6x return by 1990, taking you up to $950,000, selling when the Nikkei was near an all-time high of 38,700. Now, I think it's worth adding here that the sudden monetary tightening that the Bank of Japan actually started using in the late 1980s really could be used as a means by which investors can actually determine whether it may well be time to sell. This tightening of the monetary policy in Japan then precipitated the crisis, which saw Japan's lost decade through the 1990s. Nevertheless, Egon has got out of the market. And so the 1990s ushered enormous technological changes, which we had just started to witness taking place in the 1980s. An investment from 1990 to 2000 in the Nasdaq Technology Stocks Index realized a 9-fold increase by 2000, taking $950,000 to $8.5 million, and avoided the dot-com crash. This ushered in a new investment strategy for the 2000s, of course. During the 2000s, one of the most unloved and undervalued assets at the time was, of course, gold. The enormous growth in the money supply that had taken place between 1971 and 2000 was significant. Having witnessed Japan's crash following enormous expansion of the money supply, Egon bought gold at $235 per ounce. By 2010, this had seen a 4x return, taking $8.5 million worth of gold to $32 million. Our next decade, from 2010 through to 2020, was to capitalize on further technological gains, and with the Nasdaq still down 60% on its 2000 high, it seems highly undervalued and much unloved after the 2008 crash. By the end of 2019, this investment had provided just under a 4x return throughout this decade, taking $32 million to $121 million. The next move that Egon highlights for the coming decade is to move back to gold. But what about silver? Perhaps silver is the most unloved, undervalued asset, and that's of course something that we've discussed in these videos here. This whole approach is fascinating, and I love the way it simply attempts to find value while considering the backdrop of key macroeconomic trends that can help to ensure increased future demand. Meanwhile, focusing on assets that are unloved and very cheap provides an asymmetric investment opportunity. Moreover, this approach encourages us to consider the prospect for growth beyond gold's current bull market. Where are we likely to see the real value and prospects for future growth? Where are we likely to find cheap investment opportunities providing that potential upside? Now, certainly I have some longer term concerns regarding Western stock markets. Of course, we've seen enormous distortion here by central banks, but my long term concerns here are also down to demographics, the aging population and the high debt levels that we see within these economies. Back in the 1980s, we saw that Japan offered us the second best return over the course of the decades, and at that time had an age distribution as we can see here. At the same time, it urbanized rapidly and national debt was less than 50% of GDP. Looking at the Eurozone's demographics, we can see some real problems. The US demographics are also not as favorable as those we saw with Japan. Moreover, the high levels of debt in these economies could act as a drag not only on economic growth but also equity market growth. Yet India's recent growth has been really pleasing to note. Moreover, the age demographics seem incredibly favourable for India with a very young population. Thus, India's working age population will be far greater than its dependent population. This bulge in the working population is set to continue through until 2055 or so. Yet this alone won't drive growth, of course. A pro-business approach will be needed, and there remains enormous potential to industrialise and urbanise the economy while developing infrastructure. This will help to fuel the sort of productivity gains we've seen in China. Meanwhile, India appears set to gain from increased participation and integration within the global economy. This process seems ready to be accelerated as India is well placed to benefit from ill feeling towards China as a result of recent events. Meanwhile, current national debt is around 70% of GDP. Are there any other candidates? Well, I think another potential option is that of Ethiopia, which has also enjoyed dramatic recent growth and again benefits from the same potential demographic dividend as we've just seen with India or Japan back in the 1980s. While national debt is below 60% of GDP, certainly Ethiopia's initial movement towards industrialising bears real promise. Now, these and other similar countries seem to possess the key characteristics for rapid economic growth, offering early investors real upside potential. Now, here's a summary of the key points that we've looked at today. So just rounding up, we need to focus on value when it comes to investing, back this up with potential future demand increasing and favourable macroeconomic trends means we can then determine whether the potential rewards are likely to exceed the risks. Now, I hope you found this video useful, and I look forward to seeing you next time. Do make sure you've hit that subscribe button, hit the like button, hit me up in the comments, and do check out these videos. Bye bye.